Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of Know More, Risk Better. I'm your host, Zach Griffiths, Head of Investment Grade and Macro Strategy. And today we're going to be taking a trip into the world of emerging markets, focusing on the situation in Iran and considering how it could impact markets globally. I think getting a better understanding of the situation and the potential global economic and financial market risks is certainly key. And I have two awesome internal guests joining me to cover these crucial topics. I will be chatting with Lauren Gilbert, Senior Political Science Analyst at GeoQuant, and of course, CreditSights Head of EM Sovereign Strategy, Regis Chatellier. Thank you both for coming on the show.
Thank you so much for having us.
All right, Lauren, thanks so much for coming on. Can you just go ahead and set the scene for us a bit? It seems like the government has largely been successful at suppressing protests that reached a peak around January. Do you think the unrest and uprising is over for now? Just kind of set the table for us.
So this set of protests is over for a certain value of for now. Protests in Iran are bounded by a set of key institutions. Iran has a very good monopoly on violence, so there is a very, very concentrated elite with power over the military. And as long as those elites have sufficiently quelled the protests are done for now. However, the conditions that led to the protest are still in place, that Iran has had major currency issues. The currency in Iran is at record lows. Sanctions are crippling. It is very hard to get a lot of Western goods in Iran, and the cost of living keeps rising. So the underlying conditions in Iran are still, the regime has been weakened by these protests, and it will continue to be more fragile going forward.
And I think GeoQuant has a pretty incredible set of analysis and data set in terms of political risk. So in terms of kind of taking the temperature on the situation we're facing now, can you tell us a little bit about GeoQuant's proprietary models and what they're signaling in terms of political risk now and how it compares to recent history?
So we have a proprietary model that combines structural risk categories like, say, your type of government, your overall GDP per capita with current events that are happening. So when we look at overall political risk right now, it is now down from its peaks in January after the protests have been brutally cracked down on by the government, but it is still quite high relative to other periods that political risk is running about the same as it did in the 2019-2020 protests, which were also very large protests in Iran. So the regime is certainly weakened by these protests, and the political risk is therefore higher.
So we have elevated political risk. I don't think that's going to be surprising to any of our listeners. Regis, I want to bring in your perspective from the market side, and unfortunately, we'll kind of set aside the awful humanitarian aspects of this situation. Can you kind of give us a sense of how you're factoring in the situation in Iran to your overall assessment of risk for EM sovereigns? I know you don't cover Iran directly, but how does it fit into the balance of risks that you see to your space for 2026 going forward?
Well, first of all, I don't cover Iran on a regular basis simply because there's sanctions, right? It's not because there's nothing really to invest in at this point. That being said, it's a critical country in the region. in fact, if I look at the risk potentially, the countries I see most at risk at this point are the ones that are very dependent on the Strait of Hormuz, for their export, namely Iraq, Kuwait, and Qatar for gas exports. Some countries would probably resist a bit better in case of like a blockade of the strait, um, including Saudi Arabia, which has access to the Red Sea, and also to some degree UAE, because they could potentially continue to export, via the Gulf of Oman, but would still have significant disruption, on trade, especially considering the importance of the port of Jebel Ali in the region. So UAE would be impacted. If there was a change in regime in Iran, potentially, I don't see major risk of social destabilization in the region. Maybe Bahrain a bit because of the Shia community, which is actually the majority. Possibly the biggest destabilization could be Iraq, but I'm not even sure. But in any case, given Iraq, it has become a bit more idiosyncratic than it used to be. I see this as having a limited impact on the market. Now, the biggest risk is a blockade of Strait of Hormuz, and in this case, Oman would probably be the winner because they can ship oil directly to the Indian Ocean. They have two ports there, and Oman would probably also benefit from rising oil prices in that case. But the relative winners would be probably outside the Middle East region, like Brazil, Kazakhstan, Nigeria, Angola, these kind of oil exporters. And on but those would be most at risk would be oil importers for obvious reasons. I would put special focus on Turkey. Turkey, in a nutshell, has a pretty decent economic situation. Growth is pretty solid, considering the fact that there's been monetary tightening there. I would say, aside from geopolitical risk, Turkish bonds are quite attractive still. But in the case of big pressure on oil prices, Turkey would have it more difficult because of pressure on inflation, trade balance, and ultimately probably on FX reserves as well. And we know that the FX buffer is a bit thick for Turkey. And lastly, Turkey share a pretty long border with Iran, more than 500 kilometers or so. Potentially, if you have like bombing, you could have some refugees, and we've seen in the past that Turkey was very much on the front line as far as the refugee crisis is concerned, namely Syria. I don't expect such a deep crisis necessarily, but this has been the case in the past. So, in a nutshell, beyond the Middle East, I would say everybody could be potentially impacted by the Iranian crisis through the rising oil prices and the critical role of the Strait of Hormuz.
So, Lauren, I want to get your impression, and Regis as well. What do we think the odds are of a blockade of the Strait of Hormuz are at this point? Is that something that's a realistic possibility, kind of a tail risk? Lauren, maybe I'll start with you to get your view on that.
Hard to say, partially because the U.S. administration is very unpredictable. I think that it would be unlikely under a different administration, but sometimes the Trump administration makes some unexpected choices. It is worth keeping in mind that the U.S. and Iran are currently also having nuclear talks at the moment. So having military assets in the region is a traditional way of exerting pressure on those talks as a way to sort of show that if, say, Iran tried to play hardball in those talks or walk away from those talks, there is a military threat behind that. There's an easy way and a hard way. So I think that it is unlikely that the U.S. would use that pressure. It is there more as a threat than as anything else. But given this current administration, I can't rule anything out.
I just want to clarify, I think you're referring to we're moving our largest aircraft carrier to the region from the Caribbean. I think that's underway right now, correct, Lauren?
Yes. And of course, the U.S. has other assets in the region that even during the height of the protests, the U.S. did not have a carrier group in the region, but there were other assets and other bases that the U.S. can operate from.
Okay, so unlikely, but can't rule anything out. Regis, do you agree with that assessment in terms of the risk to a blockade of the Strait of Hormuz?
I would say it's unlikely. It's still a tail risk. But if the regime feels like, there's sort of a last resort, right? Because they would lose basically this battle, right? Basically, they could do it. They could do it. And I think this explains as well, like the situation of the current administration in the US. And there's clearly a risk also on oil prices and ultimately on inflation. So that's why I think it's still an unlikely scenario. The two have an incentive to negotiate, but that can linger for a while. And we probably have on two sides, countries that kind of stick into their position. It's still sort of difficult to know what's the outcome. But in the worst case scenarios, yeah, it can still happen. And to block the Strait of Hormuz is relatively easy for Iran because the strait is relatively narrow. You can have you have missiles, it can reach easily the Strait of Hormuz, and they have tons of hundreds of small boats, with bombs and things. And even the simply the risk of oil tanker a tanker to be under attack to simply block the traffic, right? You don't actually need the physical blockade to happen, not to have any traffic or hardly any traffic at all. So it can slow it down significantly. But it's still a tail risk in my view. But the risk would, if it materializes, it could be complicated.
All right, we've touched on this a little bit in various ways, but Lauren, I want to get a sense of the role Iran plays in the global economy right now. Regis already referred to heavy sanctions, which I think have been in place for quite a long time. There's ongoing talks. Iran's a large producer of oil, but there are only so many places it can go due to those sanctions by the U.S. and other Western nations. Can you sort of frame up to us the overall global economic risk of, let's say, further U.S. involvement or just a deterioration from these ongoing nuclear talks?
So Iran is basically the pariah power for other pariah powers. So it's a massive supplier of kind of low quality oil, but oil nonetheless, to Russia and China. And given the massive appetite for oil for industrial production in China and the war in Russia, that makes Iran really quite important, especially for Russia, where it cannot necessarily source oil on the rest of the open market. It's obviously a large domestic producer, but it is under sanctions of its own. It's also a large exporter of military drones, which makes it incredibly important to the Russians. This helps it, Iran and China have an incentive to have this not escalate to military conflict because that would affect their supply chains and their own economies.
Obviously, Iran is still an important exporter of oil despite the sanctions, and we know that. Based on the U.S. data, I think it's still around 4 million barrels a day, and which is about the same as the UAE, just to give you an idea. Again, mainly exporting to China and also Turkey that I mentioned, which is also a risk, and Central Asia. But in terms of market, the impact is more on oil. But for the rest, I don't see this as a major risk. But this risk is big enough, to consider.
So the next topic I want to tackle is an understanding of how likely we think it is the U.S. takes further military action in Iran or further intervention, whatever that may look like. Obviously, there was a direct role the U.S. played in the conflict between Israel and Iran with the bombing on June 22nd. So kind of what are you tracking, Lauren? What are you keeping in mind to sort of get a signal of an increasing or decreasing likelihood of military action by the U.S.? And overall, how does that fit into your view of the overall likelihood of further intervention as things stand today?
So I addressed this a little bit, and in the previous question that it is unlikely that the US will militarily intervene unless there's some kind of other external reason that changes the current position. So if Iran takes a action like a blockade in the Strait of Hormuz, if it decides to walk away from nuclear talks, if there is some kind of other escalation, the US has signaled that it has assets in the region so that they are ready to be used if they feel that it is necessary. So these are basically signaling like, we can use these, so like, please don't make us. And the administration is also, the Trump administration is using Donald Trump's unpredictability, that the State Department is aware that everyone around the world thinks that Donald Trump is unpredictable and might militarily intervene in places where another president would not. So this also helps bring Iran to the table as far as getting concessions, because they have the possible threat of, they cannot necessarily rely on like a small escalation. Donald Trump might decide to do something big and splashy instead.
So I think it's interesting just to consider the unpredictability, and I think perhaps the decision back in June of 2025 was a bit surprising, and kind of keeping an eye on, if there's a blockade, that would certainly be a shift in the approach by Iran that would probably cause a reaction by the US walking away from nuclear talks. How much do you think a potential re-escalation of protests could fit into how the US is thinking about taking further action? Is that kind of at the margin, and you need something bigger to really shift the balance of risks? Or if there were to be another uprising similar to what we saw in January, do you think that alone could be enough?
I think it would probably take something larger. Donald Trump's coalition is not particularly interventionist, and you're already seeing some internal elite frictions over a like more interventionist role that the second Trump administration has taken with Venezuela. And direct military intervention in Iran would be a significant escalation. And the Trump administration and the Republicans are going into a midterm year. So they do not necessarily want to alienate their coalition that has been largely built around the idea of America first and let's keep out of other people's affairs. Even if there are many Iran hawks in the Trump administration, there are reasons that Republicans in Congress and the administration itself might want to step back away from direct escalation.
Do you think the actions in Venezuela shift the balance of appetite for interventionism? I mean, that was a huge move. I think perhaps in retrospect, there had been signs of building toward some type of crescendo in terms of our approach to Venezuela. But do you take that as sort of a one-off, or maybe a greater willingness to have more of this interventionist role, even though that really was not the communicated message of the administration, I think, on the campaign trail and as they kind of took power about a year ago?
So there are two things pulling in opposite directions. One is that Trump is unpredictable. I think very few people predicted that he was going to kidnap Maduro. We are seeing a very real example of it is hard to predict the Trump administration, and predicting the Trump administration's actions may be a little bit of a fool's game. However, the sort of internal elite politics of we actually don't want to intervene. Foreign wars have not gone that well for us in the 21st century, particularly post-Venezuela. There is a sense in the US of like, well, we already now have to deal with Venezuela. We can't do Iran as well. Or maybe we could, but like that is a lot of political capital to be expending, particularly during a midterm year. And with internal events in the US, like the protests against ICE, the Trump administration is in some sense like there are only so many fires they can have at the same time. They probably should not start another one when they're busy trying to put out other ones. But because it is the Trump administration, I can't rule out that they will.
That's a great point. And so I think that's a great transition to Regis again, kind of getting more of the market's sense. I want to know, Regis, what are you thinking in terms of geopolitical risk compensation that's currently priced into EM sovereigns? I mean, to me, for the U.S. and perhaps a broad set of asset classes, it seems like there's little risk premium to be found anywhere. And so when you think about, I wonder if it's the same for EM. I think my sense from other conversations we've had is that there is very little risk compensation at all, let alone geopolitical. But how does that kind of fit into your overall view for the EM space this year?
Yeah, yes, indeed. I mean, I agree with you. There's only one asset. I mean, it's not really an asset, but basically the geopolitical risk is increasingly priced in the oil market, right, with risk premium. But we're not there yet. I mean, it's still below 70, so I can't say this is a huge risk premium. But clearly not in the bond market, right? I mean, if you look at sovereign IGs, they trade at an average spread of 90 basis points over treasuries, and sovereign high yield traded below 300 basis points, I think close to 290. I mean, we're basically at the tightest level since 2007. So basically nothing is priced in, and it is not only EM. What is supporting EM is actually, some form of resilience. We had EM had a bit of a tough environment last year with the Trump administration targeting a lot of EM countries. Actually, most of them were targeted by tariffs, and the same configuration not so long ago would have triggered a massive repricing. There was a bit of repricing, but it didn't last, and they still have significant tariffs. But basically, the market continues to assume that the stars will continue to be aligned whatsoever. The only thing that market seems to be or to care of is the risk on the Fed, right? Potentially. So if there is a significant risk, but again, I think people tend to forget that the risk on the Fed is also it basically linked to the risk on inflation, and the risk of inflation could be also linked to other type of risk. And I think the crisis in Iran is one of them. So we are at the tightest levels since 2007, despite quite a few geopolitical risks around. Market continues to be quite complacent about that. So that's why I tend to be quite defensive in the market. Not because of EM fundamentals. I think they are quite resilient, and it's going to be still probably the case next year. But I'm a bit concerned about valuations across markets, and EM is part of this equation. Difficult to see some spread compression going forward, and the balance of risk we have geopolitical side is we need to think about it a bit more, I think.
Lauren, I want to get your sense, hearing Regis say that EM sovereign spreads, whether it be investment grade or high yield, are basically at the tightest they've been since 2007. Does that surprise you when you think about not just political risks in Iran, but kind of what you're seeing broadly from GeoQuant's perspective? Does that seem like a mispricing of risk in the system to you? And I know, you're a political science analyst and maybe
Political scientist, so I am not entirely sure I am qualified to answer that question.
I mean, I guess thinking about the models and kind of what you see from the GeoQuant side, though, does it seem like having relatively little risk premium in markets, does that make sense to you?
It makes some sense relative to there is increasing risk in developed markets. So in some sense, you might have less of a risk premium in emerging markets because developed markets, your counterfactual use is now looking riskier.
I would agree with this. I mean, if I jump on the conversation, I would agree with this. And I think in a way, looking back, I mean, it was difficult to justify that valuation was so tight. I think it continues to be too tight, but looking at the developed markets, EM looks relatively decent. It doesn't mean that it deserves more spread compression. It means that if there is a repricing, EM is probably going to be more defensive or more resilient than in the past.
That's a great point, Regis. I'd love to just sort of wrap up things here with your favorite picks in the EM space. I think this narrative of growing at least fundamental risk in developed markets versus emerging markets certainly resonates with me, analyzing what's going on with the Treasury and the deficit and where all this issuance will eventually need to go. I think the Fed is right now providing a fair bit of support, buying 40 billion of T-bills per month, and we think that it could certainly help with the supply and demand balance dynamics going forward. But if you're someone that's in the camp that developed market fundamentals are in a bad place and they're only going to get worse in the near term, and maybe you're not getting compensated a ton to move into emerging markets, but you still think that the fundamentals there are better, what names and what bonds, I guess, what countries would you invest in or recommend to clients in that situation?
Way it has become a difficult call because it's been basically 3 years of continuous spread tightening, and there is hardly any relative value, out there left. People had plenty of time to see where's the value, right? And we hear that, from clients, okay, tell me what's next. Difficult to see any value of IG, right? Because it's trades super tight. So it's basically treasury risk at this point. Honestly, if you make like 5 basis points on a credit, you're happy with that. So it's not really exciting. I think the very high yielders had a very good stories overall. We had like Argentina and, Nigeria, positive stories. Also Turkey. But I think it's a bit overpriced considering that the risk of, in the market that can materialize. I'm more in favor of like mid-tier credits, like, sort of like high double B sort of names. And more like some sort of, I wouldn't say frontier market, but kind of smaller credits. I like Morocco, Dominican Republic, these kind of things that they sometimes, they have been a bit below the radar, but fundamentals continue to be quite supportive. And also LATAM is interesting region this year because, we had quite a lot of elections, and the country or the continent is shifting clearly to the right. So independently from political views, I think there will be a more fiscal consolidation going forward, which is meant to lead to kind of a stronger credit fundamentals from the, market perspective. And in a way, that region appears, maybe Brazil aside, but that region appear more conservative, more cautious, and more responsible from the fiscal standpoint that a lot of developed markets, starting with the US. So countries like Chile, Peru, even Colombia, right? I think we could be at a turnaround, and probably the risk is probably priced in at this point. So LATAM is probably a place to look. Middle East, I'm a bit cautious. Turkey, clearly more cautious than I used to be, probably market neutral now. In Asia, it's quite tight. So I would stay sort of, I wouldn't say, I would stay neutral, but I don't see much value in Asia at this point.
Okay, so maybe best opportunity in LATAM, you're kind of downgrading your view a little bit in terms of Turkey, and Asia a little bit unappealing, at least from a relative value perspective. Lauren, Regis, this was a great conversation. I really appreciate you both coming on the podcast. Lauren, I'd love to have you on in the future as this situation develops, and I'm always in regular touch with Regis, so I'm sure we can put together another great discussion as things unfold. So that's Lauren Gilbert, Senior Political Scientist at GeoQuant, and Regis Chatellier, our Head of EM Sovereign Strategy at CreditSights. Thank you both.
Thank you so much for having me.
And thank you all for tuning in. We'll catch you next time on No More Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.